Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Eos Energy Enterprises.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis of Eos Energy. When we look at the financial data, particularly from Q3 2025, we're not just seeing growth. We are, I think, witnessing a fundamental inflection point for this company.
It's an inflection point. That's a strong way to put it. And it's that acceleration that has everyone buzzing about this story, right?
Exactly.
The revenue jump is, well, it's almost unbelievable. We saw Eos hit $30.5 million in revenue in Q3.
30.5 million. And just for context, that's up from what, 15-ish in Q2?
15.2 million in Q2, so it's sequential doubling. But the really dramatic leap is from the same quarter just 1 year prior. They reported just, tell them once, $9 million.
Under $1 million.
From under $1 million to over $30 million. That shift is just, it's staggering.
And what that signals is commercial validation. This growth is proof that large-scale customers are moving past the pilot phase.
They're all in.
They're all in, fully committing to the technology. And we can trace this directly back to some major contract wins. Specifically, the market is focused on that big 228 milliWh contract with Frontier Power. And even more critically, the massive 750 milliwatt deal with MN8 Energy. These deals don't just add revenue, they prove the tech can integrate into real operational energy infrastructure.
Okay, so the top line is clearly exploding.
Yeah.
But in the world of scaling up manufacturing, that often comes with a huge hidden cost, doesn't it? So the question is, how is management addressing the efficiency side? Can they actually sustain this pace?
That shifts the focus squarely from revenue to margin execution. Now, management's guidance is still really confident. They're targeting full year 2025 revenue between $150 and $160 million. But the internal efforts to cut costs are arguably even more important right now. They're aggressively chasing efficiencies, and the numbers are starting to support the story. They reported an impressive, a 45% reduction in scrap costs.
Wow, 45%, so way less wasted material.
Exactly, and an 18% improvement in labor and overhead absorption.
Reducing scrap by almost half in a physical manufacturing process is a huge deal. But let's clarify the ultimate financial goal here. They've set two very specific targets, right? Positive contribution margin by Q4 2025, and then positive growth margin by Q1 2026.
Yes.
What's the difference, and why is that Q1 2026 target the major hurdle?
That's a key distinction for anyone looking at this stock. Contribution margin is essentially revenue minus all the variable costs.
So materials, direct labor, that kind of thing.
Exactly. Hitting positive contribution margin means they're making more money on each individual battery they sell than it costs to physically produce it, which is good.
Okay, so they're covering the immediate costs of making the thing.
Right. But the positive gross margin target for Q1 2026 is the real game changer. Gross margin adds back the fixed costs, factory rent, equipment depreciation, all that overhead.
Oh, so all the infrastructure.
All of it. If they achieve positive gross margin, it means that the profit from their sales is now covering all of their manufacturing costs. Hitting that Q1 2026 goal means the company starts operating as a truly viable enterprise. If they miss that, well, the market will punish them severely.
That makes the narrative so much clearer.
Yeah.
So if they're achieving these massive cost savings, what is it about their core tech that allows for that? I mean, this kind of demand surge suggests they have a real competitive advantage. What's their moat against the lithium giants?
The moat is built around their chemistry. Zinc-based, specifically zinc-bromine battery technology. That's the fundamental differentiator.
Right.
I mean, most of the grid storage market relies so heavily on lithium-ion batteries. EOS's Z3 system is critical mineralite. This is a massive advantage because it relies on materials that are domestically sourced and, well, widely abundant, mainly zinc.
So they completely sidestep the entire geopolitical mess that surrounds lithium and cobalt sourcing.
Precisely. They are resilient against all that supply chain volatility and the geopolitical risks. But the technical advantage is just as compelling. They are focused on long-duration storage. We're talking 6 hours or more, which now makes up 65% of their entire sales pipeline.
And we're hearing more and more about that 6+ hour capability. Why is that specific duration so important right now?
It's the sweet spot for two huge structural shifts. First, for grid resilience and renewables, utilities need to store solar and wind power not just for an hour, but often overnight or through peak demand. Lithium can do it, but the cost for 6+ hours starts to get prohibitive compared to zinc.
And the second shift we keep hearing about, the AI power boom.
That ties directly into the energy supercycle. AI data centers are just relentless, massive power consumers 24 hours a day. They don't just need a 5-minute backup, they need reliable storage that can run for hours if the grid falters.
And Eos's tech is perfect for that.
Perfectly situated. It offers a reliable, domestically sourced alternative that doesn't compete with the insane demand for lithium in the electric vehicle market.
That is a really powerful thesis. But a great technology story is, useless if you can't actually build it at scale. Are they prepared to meet this demand?
They're acting like a company preparing for war. I mean, they are aggressively scaling their U.S. manufacturing capacity to an annualized run rate of 8 gigawatt hours.
8 gigawatt hours. That's a significant industrial undertaking.
It is, and it's being heavily backed by public support, including $24 million in governmental incentives. This IP-protected, localized production creates two key advantages. It lowers risk for big customers who want a domestic supply, and it builds significant switching costs.
This all sounds incredibly compelling, but it takes enormous amounts of cash. How they manage the money side of this, especially since battery manufacturing is so capital-intensive.
To finance this aggressive scale-up, the company just executed a pretty substantial balance sheet overhaul post-November 2025. It was a move they had to make.
Okay, let's talk about the fine print here. $1 billion raise is huge. How exactly did they structure that, and what does it mean for current shareholders? The idea being you sacrifice a small percentage now to get a much larger share of a much bigger pie later.
That's the argument. Without the capital, that $22.6 billion pipeline just can't be fulfilled.
Let's look at the historical numbers. The trailing 12-month net income is deeply negative. We're talking losses nearing $2 billion. For an average investor, that sounds catastrophic. How much of that is, accounting noise versus actual cash flying out the door?
That's a really important question. The $2 billion loss is a scary headline, but it's crucial to understand the GAAP accounting. A substantial portion of that is non-cash adjustments.
Non-cash, meaning?
Things related to the mark-to-market valuation of their previous convertible notes and warrants. It's noise on the income statement that doesn't represent cash flowing out today.
No, it's not $2 billion in hard cash that just vanished. It's more of an accounting consequence of their past financing.
Precisely. The cash burn is significant. Yes, that's why they needed the $1 billion. But that gigantic GAAP loss figure is heavily inflated by these non-cash items. The market seems willing to tolerate this moon as long as they hit those margin targets by Q1 2026.
That makes the trade-off much clearer. Now, let's just revisit the sheer potential here. What's the size of the pipeline this new capacity is being built to serve?
The potential is immense. The current sales pipeline stands at a whopping $22.6 billion. That represents 91 GWh of potential storage capacity.
That's growing.
It's a 20% increase just quarter over quarter. More concrete is their firm backlog signed and secured orders, which stands at $644.4 million, or 2.5 GWh. The entire success of the business hinges on converting that massive pipeline into revenue.
So now that we understand the tech and the capital structure, let's pivot to the stock itself. How has the market reacted to all this?
The price action has been, I'd say, generally constructive post-financing. We saw a definite jump, a 10.2% surge after the equity raise.
Which suggests the market saw the cash as a net positive despite the dilution.
It does. Technically, the stock is forming higher lows, which analysts see as a bullish base. The level to watch is a breakout above that $15.78 resistance range. And on the downside, key support seems to be holding around $11.46.
We have momentum, but this stock is known for its volatility. What does the skepticism that's already priced into the stock look like?
The skepticism is loud and clear in two metrics. First, short interest is extraordinarily high at 27.06% of the float.
27%. That is a huge chunk of shares betting against the company.
A very significant chunk. It signals deep-seated doubt about their execution. Second, the stock has an elevated volatility with a beta of 2.15.
So if the market moves 1%, this stock, on average, should move more than 2%.
That's right. It is not for the faint of heart. And this risk profile is also reflected in the actions of insiders. We've seen some sales, including a director selling around $487,000 and the CEO selling $1.9 million over the past year.
The CEO selling always spooks investors. Should we read that as a lack of confidence?
It definitely warrants caution. Now, insider selling can be for personal reasons, of course, but when it happens alongside high short interest, it just adds fuel to the skeptical argument. It reminds everyone that while the upside is huge, the risk of failure is also significant.
So on the flip side, What are the near-term positive catalysts we should be watching for? What could trigger a major move up?
Well, the next few weeks are densely packed. The immediate focus is the Q4 2025 earnings report, likely in early February 2026. The market will scrutinize every single data point there.
Looking for that progression toward the revenue guidance and the margin targets.
Exactly. And then they're taking this story to the global stage, aren't they?
Right, Davos.
Yes, in January 2026, they're at the World Economic Forum. This isn't a typical investor conference. This puts their zinc technology in front of global policymakers, major industrial partners, and huge government clients.
And beyond the company itself, the macro environment seems to be helping them out.
Absolutely. The macro tailwinds are strong. You have expiring clean energy tax credits, driving installations, the AI power boom creating relentless demand, and the expectation of lower interest rates, which usually boosts renewable energy projects.
And finally, there's always the speculative side.
Correct. There is persistent chatter about unannounced utility contracts or, even more intriguingly, potential Department of Defense wins, given the government's focus on non-Chinese domestic energy infrastructure.
This is such a fascinating story. It's a classic trade-off. You have this immense demand and a clear tech moat with zinc, but that's balanced against near-term losses, dilution, and just intense execution risk.
It is.
If Eos can convert that $22.6 billion pipeline and actually hit those Q1 2026 margin targets, that billion-dollar financing will be seen as a brilliant, necessary move.
It all comes down to the factory floor. The long-duration storage narrative, especially for AI and grid resilience, provides a multi-year horizon, but they have to deliver on the 8 GWh scale. The fact that major analysts see price targets in the low $20 tells you that the value is only unlocked by successful execution.
That execution risk is the final hurdle, the moment of truth. We'll be keeping a close eye on those Q4 earnings and what comes out of Davos. If you enjoyed this analysis into Eos Energy Enterprises, remember to subscribe, like, and share Smart Wealth with Joshua. We'll be back tomorrow with more analysis.